Most traders lose money for one simple reason. They don't know where price is likely to react. They buy after price already moved up, they sell after price already dropped, and then they wonder why the market keeps stopping them out. The difference between losing traders and profitable traders is support and resistance. And once you understand these levels properly, trading becomes a lot simpler. In this video, I'll show you exactly how to find and draw the strongest support and resistance levels using 3 detailed rules. And then I'll walk you through 3 proven trading setups you can start using today, even as a beginner. Now, what support and resistance actually are. Support is an area where price repeatedly struggles to move lower because buyers stepped in. Resistance is an area where price repeatedly struggles to move higher because sellers stepped in. These aren't just random lines. They are zones where decisions are made. When price reaches support, buyers see value. When price reaches resistance, sellers see opportunity. That's why price reacts so cleanly at these areas, because money is being exchanged there. Rule number 1. Always start with the higher time frames. This rule alone will instantly improve your trading. Most beginners make the mistake of drawing support and resistance on very low time frames, like the 5-minute chart. The problem is that lower time frames are noisy. They show a lot of random movements that doesn't matter. Strong levels, however, comes from higher time frames, specifically the daily charts and the weekly charts. Why? Because that's where institutions, hedge funds, and large traders make decisions. When price reacts on a daily or weekly chart, it means a lot of money was involved. Levels formed on higher time frames are more reliable, gets respected more often, and works across all lower time frames. Once you mark your major daily and weekly levels, you can then drop down to the 4-hour or 1-hour time frames to look for entries. But the key point is, the levels must come from the higher time frames first. This prevents overtrading and keeps your chart clean. Rule number 2. Round numbers are psychological levels. The market is driven by people, and people think in round numbers. Traders naturally place buy and sell orders around clean prices like 50, 100, 500, 1000, or 3000. These prices stand out visually and mentally, which is why the market often reacts so strongly around them. When price approaches a round number, several things happen. Traders take profits, new buyers hesitate, and sellers become more aggressive. This creates hesitation and reaction, which is exactly what we want as traders. What makes round numbers even more powerful is when they line up with previous highs or lows. When structure and psychological align, that becomes extremely important. So, anytime you see a round number that price has respected before, mark it. These levels often act as strong resistance before a breakout and strong support after a breakout. Rule number 3. Strong moves create strong levels. This rule helps you spot the most powerful levels on your chart. When price moves quickly and aggressively away from a level, that's a big clue. Fast moves don't happen randomly. They happen because large players entered the market with size. If price touches a zone and then shoots up with strong bullish candles or drop fast with strong bearish candles, that level matters. It means there was a strong imbalance between buyers and sellers at that area. The stronger and faster the reaction, the more important the level is. And if price reacts strongly from the same area multiple times, that level becomes even more reliable. Anytime you see a sharp rejection or explosive move away from a price zone, mark it. The market is showing you exactly where real interest was. Now, here's something very important most traders miss. When a strong resistance level finally breaks, it often turns into support. And when a strong support breaks, it often turns into resistance. This is called role reversal, and it signals a change in the market sentiment. For example, price may get rejected several times at resistance, but once it finally breaks through, price often comes back to test that same level. If buyers defend it, the old resistance is now new support. These retests are some of the cleanest and safest trade opportunities because the market is clearly showing its direction. Now that you know how to draw strong levels, let's talk about execution. Levels alone are not enough. You always wait for confirmation. Setup number 1. Bounce or reversal setup. And this is one of the most common ways I trade support and resistance. First, price approaches a key, support, or resistance level that I already marked from the higher time frame. At this point, I'm not entering immediately. A lot of beginner traders make the mistake of trying to predict the bounce before the market actually shows any sign of reacting. Instead, I wait. I want to see how price behaves when it reaches that level. If the level is truly important, the market will usually give us some type of reaction. What I'm specifically looking for is a rejection candle, which tells me that one side of the market attempted to push price further but failed. Some common examples of rejection candles are a hammer candle, where price pushes down but buyers step in and push it back up before the candle closes. A pin bar, which shows a long wick rejecting the level, or a bullish or bearish engulfing candle, where the new candle completely takes control and closes over the previous candle. Let's say price comes down to a support level and forms a solid pin bar. What this tells me is that sellers try to push price lower, but buyers step in aggressively and force the price back up. That's the first sign that the support level is being respected. But I still want one more layer of confirmation before entering the trade. This is where I bring in the 20 EMA, which stands for the 20-period exponential moving average. The way I use it is very simple. If price closes a candle above the 20 EMA after rejecting support, that tells me momentum is shifting back to the buyers. At that point, I'm looking for a long entry. So my trade will look like this. I enter the trade after the candle closes above the 20 EMA. My stop loss goes just below the rejection candle, because if price breaks below that level, it means the support is no longer holding. For my take profit, I usually target at least 2 times my risk, also known as a 2R trade. So if my stop loss is 20 pips, my take profit would be around 40 pips. Now, if you've made it this far into the video, consider dropping a like and subscribing. It really helps the channel to grow. Now back to the video. Setup number 2, the breakout and retest setup, which is used when the market decides to continue moving in the same direction. One thing you'll notice when looking at the charts is that strong levels rarely break on the first attempt. Price usually tests a level multiple times before it finally breaks. Every time price touches that level, more orders get filled and the level slowly becomes weaker. Eventually, the market gains enough momentum to break through it. Now, here's where most beginner traders make a mistake. As soon as they see the breakout candle, they jump into the trade immediately. But the problem is that many breakouts are actually fakeouts, and price often pulls back before continuing. Instead of chasing the breakout, I wait for something called the retest. After price breaks a resistance level, it often comes back down to test that same level again. But this time, the old resistance should act as a new support. So, here's exactly what I'm watching for. Price breaks above the resistance level with strong momentum, then price pulls back towards that same level. If buyers step in again and the level holds, that tells me the breakout is likely real. Just like with the previous setup, I also check the 20 EMA for confirmation. If price pulls back to that level and then closes above the 20 EMA, that's usually my signal that buyers are still in control. That's when I enter the trade. My stop loss goes below the new support level or below the retest candle. My take profit again targets around 2 times my risk, or the next major resistance level on the chart. This setup works well because you're entering after the market has already proven that the breakout is legitimate. Setup number 3, the fakeout or liquidity grab. This is personally one of my favorite setups because it often produces some of the best risk to reward trades. To understand this setup, you need to understand how the market works. A lot of retail traders place their stop losses right above a resistance or right below support. Large institutions knows this, and they sometimes push price slightly beyond those levels to trigger these stop losses and collect liquidity. When that happens, price breaks the level briefly, which makes it look like a breakout. Breakout traders enter the market thinking the price will continue in that direction. But instead of continuing, price suddenly reverses. This is what we call a fakeout. And here's exactly how I trade it. Let's say price is moving inside of a range between support and resistance. Then price suddenly breaks below the support level. At this point, many traders panic and enter short positions. But instead of selling immediately, I watch how price reacts after the break. If price quickly moves back above the support level, that's the first clue that the breakout failed. Then I look at a strong reversal signal, such as a bullish engulfing candle. That candle shows buyers stepping in aggressively. Once price reclaims that support level and confirms the reversal, that's where I enter a long trade. My stop loss goes just below the lowest point of that fakeout. Because the stop loss is small, the potential reward becomes much larger. For this setup, I usually aim for a 3-hour trade, or even a 4-hour trade, targeting the opposite side of the range. Now you understand support and resistance. But if you really want to catch the real moves, you'll need supply and demand. That's where the big money enters. Click the next video, I'll show you exactly how it works.